And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning. Is it time to short the vax mandates? That's going to be one of our topics today, along with the Federal Reserve. What's coming up? Their meeting next week. Does that mean we're about to see a 50 basis point rate hike or more before we get there? What about that expanding balance sheet? Are they about to start actually tapering that balance sheet even faster than expected? All that's coming up on the show this morning. Michael Lebowitz will be joining me here in just a few minutes to get through that. Lots of stuff to cover here, particularly over the last few days. Markets have been under a lot of pressure here, and yesterday another sell-off. Markets are now fairly well deviated from their 50-day moving averages. Again, as we talked a little bit about yesterday, the S&P now trading down below into 3 standard deviations below the 50-day moving average. I know, technical mumbo jumbo, don't worry about it. All it means is that the markets are really oversold here, and we're likely going to see a bounce. And in fact, this morning, futures are pointing up a little bit higher this morning. NASDAQ looks to recover the fastest. As we addressed yesterday, again, if you go by our website, realinvestmentadvice.com, we have a video out yesterday, our 3 minutes on markets and money. It's right there on the front page talking about oil prices, because higher interest rates by the Fed is actually a negative for energy prices. And energy stocks are grossly overbought here. Technology is very oversold. Maybe time for rotation. So go by the website, lots of stuff there to cover, but in the 3 minutes on markets and money specifically, we talk about that. So that's on the website, realinvestmentadvice.com. So this idea about vax mandates, interesting. We're finally starting to see some thaw in these vax mandates, kind of shutdown rules, mask wearing, etc. You know, there's been a lot of contention, and of course that has also impacted consumer confidence because, again, if I'm worried about going out into the world to shop, to do things, I'm not going to do it. That's bad for economic growth. And in fact, first quarter economic growth numbers are being revised down sharply as we continue through this whole kind of, COVID nightmare that we've been in for the last couple of years, this more dystopian type society we've been living in. So England yesterday said, that's it, we're done. No more mask mandates, no more vaccine passports, we're done with it. We're getting back to normal, we're gonna go back to work. This is really an important change by a country, and hopefully will kind of lead the way for the rest of the world to get past this and start treating the COVID as just an endemic situation, just like we have with the annual flu, right? You get sick, you get over it, you move back on, you go to work, and it's time for us to grow up, put our big boy pants on and get back to work, doing things, because that's what creates economic growth. Living in fear is never a good option for any country, and it's time that we start moving past this. England now making that move today. So if that's the question, right? If that's the question here, is that if we are going to be moving past these vax mandates, rules, etc., is it time to start shorting the vax makers? And again, these companies are making as much as $1,000 a minute on vaccines, which is, just pretty astonishing. But, you say, well, yeah, but this is probably a good idea. We're eventually going to get past this. We're going to get past the mandates. We're not going to need the vaccines as much. And, we're going to get back to normal of just doing things. And that's going to slow the demand ultimately for these vaccines that are coming out. But this has already been something in the works. You're too late. If you want to short vaccine makers now, you're too late. The market picked up on this about 2 months ago, actually back in September, October, is where Moderna, as an example of this, actually peaked and has been selling off. And again, we're going to start to see this. Market picks up on this sooner rather than later. And what we're already seeing here is that we're already starting to move past these ideas of vax mandates. The whole premise is starting to slowly fall apart. We're starting to see a lot of walk back on, previous recommendations, et cetera. The CDC out yesterday, just a couple of days ago, saying, hey, cloth masks, they don't really work. So, we're going to start to slowly see this walk back here. That's already putting pressure on vaccine makers. So be a little bit careful on this trade, because it got way overdone here previously as people were chasing these stocks on the way up. They're now going through a big correctional process here. So again, this is one area of the market you want to be a little bit cautious of. As we talked about yesterday, energy also well overdone here. Likely going to start to see some pressure in energy as well. In fact, when you have big deviations in performance like you have now between energy and the S&P 500, energy always reverts back to the S&P 500 on a return basis. So we're probably going to see a correction in energy stocks. We're probably going to see more pressure on vaccine makers specifically as, again, we kind of return back to a normal world here and start getting back to work and doing things. Now, the good news about that is actually good for economic growth. That will start to restore consumer confidence, which just printed a new low, one of the lowest levels since 2014 on consumer confidence. And again, that's something that's very important to the overall global economy. We have to get people back to work. They have to go back to earning a paycheck. They've got to get back to seeing friends and family and all these type of things. That's what makes the economy work. And we need to get more of that going. So again, watch consumer confidence here, because that's one big drag on the overall market and the economy right now, is that, and this is why you're seeing first quarter GDP growth being revised down sharply here. Fourth quarter came in about 50% of what was originally expected. And that's really been the base case over the last year, is that we had really high hopes of exponential growth in the economy. Just never really occurred, because we never allowed the economy to get back to an organic function. So now the Fed's talking about hiking rates. This is something we're going to talk about with Michael Lebowitz in a few minutes. If you take a look at TIPS as an example here, TIPS yields have actually been coming back down again. The price of TIPS has been falling fairly dramatically. And that suggests that we may have seen an inflationary peak in a lot of these numbers. And again, particularly as you see the economy starting to slow again, there is a very high correlation between inflation and economic growth. So if economic growth is going to fall and is going to weaken this year, as we expect it will, then that is also going to drag down inflation. So the question that we'll talk about this morning is the Fed really too late to the game now to be hiking interest rates, and particularly being more aggressive about their policy at a point where inflation may have already peaked? Now, again, we don't know the answer for sure, and we won't know that for a few more months. But it's an interesting premise, because if the Fed begins to aggressively hike rates and tighten monetary policy, and the economy slowing down at the same time, outcomes for financial markets tend not to be very good. So this is something we'll get into a bit more this morning with Michael Lebowitz. Also, again, next week, we've got the Federal Reserve coming out. They'll be talking about their policy, right? This is where we're going to get really kind of a more concrete view about what they're going to be doing with policy, how fast. Right now, the odds that the Fed will hike 50 basis points by March is now over 100%. So again, the markets are getting very convinced here that the Fed's going to be much more aggressive about hiking rates. Now, historically, what they want to do is try to stop their balance sheet expansion before they hike rates. So if they're going to be hiking rates in March, what does that mean for QE? They're currently still doing their $100 billion a month or so in QE. So if that's got to stop before they hike rates in March, one of the big things that could kind of hit the markets next week, and we're certainly kind of preparing for this, is the Fed to say we're going to be much more aggressive about that roll-off of the balance sheet. In fact, we're going to go to zero by February. Now, I'm not saying that's the case, so don't run out and start making big panic changes. I'm just saying that historically they tend to want to taper their balance sheet before they do rate hikes. And if that's the case, that could suggest a much faster taper to the balance sheet. That would certainly be outside the purview of what the markets have been thinking the Fed will do. And again, that's one of the risks as we go forward. So we'll get into that this morning and more with Michael Lebowitz. So stick around. All that's coming up on the show right here on the realinvestmentadvice.com. Get by there, get our 3 minutes of markets and money that was out yesterday. Our daily commentary is already posted. Just click the link, the banner on the front page, realinvestmentadvice.com. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. Realinvestmentadvice.com. Click on the insurance tab.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Good morning and welcome to the show. Hang on a second, I'm having technical difficulties with my mic here. It is, of course, Thursday, second best day of the week. That means Friday's right around the corner and get ready to roll through this. It's been a nice short week, right? Holiday shortened week, so things kind of move very quickly. So as I was talking about before, there's a lot of things that have been going on in the markets for the last few days, lots of selling pressure. And we actually have a chart in our daily commentary this morning, which is on the website at realinvestmentadvice.com, that shows the market is, on the S&P basis, is very oversold. Now, we're down at levels that normally elicit at least a rebound short term. And just because you're very oversold doesn't mean we're about to have the next great bull market in the S&P, but we are at levels that typically suggest you're going to get some type of reflexive activity here. So, as we've been talking about, there's a lot, and we're talking about more this morning, there's a lot of risk as we move into 2022. Fed policy is probably the biggest one. And so, as we talk about those things, those are impacts to markets that have not fully occurred just yet. In fact, if you take a look at a correlation between the PE ratio of the S&P 500 and inflation, the PE ratio of the S&P should be historically much lower than it is now. And what that tells you is that the price correction in the market hasn't occurred yet. So if that outlier event of what's happening between valuations and inflation comes back into line, it suggests a fairly sharp correction for the market sometime this year or early next year. Again, timing is always the big issue. But we certainly have all the catalysts out there. And one of those, as I was saying just before the break, is that the Fed is going to be one of the big catalysts for the markets and market outlooks. So again, you want to use this rally as an opportunity that you can use to rebalance risk in your portfolios, reposition, think about where you want to be. And again, it's important not to be overly bearish here, right? This isn't a time to go hide all in gold and cash and the world's going to come to an end. I'm not saying that at all. But we are talking about a rotation maybe into companies that have more fundamental value. And as I was talking about a second ago, more and more companies, Starbucks has now joined the growing list of companies that are getting rid of Vax mandate rules. England has gotten rid of them entirely, and that's going to start to spread. This is small now, but this is good news. Is that we're going to get past all this, right? We're going to get back to being normal, get back to living life and doing what we've got to do. That's good for the economy, right? That's really good for the economy. Got to get back to normal. And this is also going to kind of be part of the function of the markets themselves as we go forward. So, again, not everything is going to recover. And areas that have run up in big ways, energy as of late is a good example. We took some profits out of our energy stocks on Tuesday because they're very extended here. We've had a big, kind of an outsized abnormal run in energy stocks lately, people just kind of piling into that value trade all of a sudden. And now we've got this kind of bifurcation between energy and the rest of the markets. And those are going to correct. Those won't sustain themselves long term. Small caps, something we'll talk about more this morning, have been under a tremendous amount of pressure, right? Just broke down out of their consolidation channel, suggests that small caps and really even mid caps have a lot more trouble ahead of them. And that's not surprising because they don't have the ability to do massive amounts of stock buybacks and fend off inflation by passing on costs. So lots of things to be concerned about here. But again, the biggest driver, and I've got Michael Lebowitz joining me this morning to talk a little bit about the Fed, because next week is going to be potentially a very pivotal moment for the markets and for policy, because if the Fed is going to be taking more aggressive action, I would suspect that they're going to start it at this next meeting. Right now, Fed Fund futures are suggesting a 50 basis point hike by March. So, Michael, welcome to the show this morning. How are you?
Thank you. Thank you for having me.
Sure.
Thought you were just going to keep going and forget about me here.
Nah, never. Just setting the premise, the baseline here. We got a lot of stuff to get into between the Fed policy and how to manage portfolios between now and the rest of this year. So, but again, this is kind of, if history, and as I was saying kind of in the opening monologue, is that if history, kind of holds up here, the Fed tends to want to taper off their quantitative easing, in other words, reduce QE and get into a balance sheet runoff situation before they hike rates. And Fed Fund futures right now are pointing to a 100% chance that the Fed will hike by 50 basis points in March. So that would suggest a much faster taper policy than maybe what the markets are expecting. What do you think?
Yeah, and Lance, you forgot there's a little bit of news that happened last night that I think has a much bigger effect, and this has been going on. Last night, the Senate voted down the filibuster, which essentially squashed the Democrats' voting rights bill.
Right.
And if you've been paying attention to Biden and his press secretary and other members of Congress, the word inflation is coming up more and more in what they're saying and how they intend to deal with inflation. So I think starting today, because they lost the voting rights bill, that would have helped them out, I think, and, at least keep their own Democratic voters in the coming elections in November, inflation just becomes more and more of an important topic. And how do they squash it? Because real wages, or the amount you make after inflation, are falling for in aggregate for the economy. Goldman Sachs yesterday just said that their expenses rose 33%, of which more than 33% was due to wages increasing. So this is really starting to affect companies. Companies cannot pass this on. I think we're going to start, that's going to be a familiar theme within the earnings reports. And I think most importantly, tomorrow, maybe this morning, Chairman Powell is going to get a call from Biden saying, you got to do something about inflation today, right? Well, so, but let's think about this for 1 second. The Federal Reserve right now is stimulating the economy to a degree that they have never stimulated before.
Correct.
Even with what they have done in reducing QE, the annualized rate of QE is slightly more than they were doing at the peak of the 2008 financial crisis.
Yeah.
Think about that.
Yeah.
That's stimulating the economy. Interest rates are still at zero. Lance is talking about all these future interest rates rising, but the Fed has their foot pinned on the gas pedal. So what's going to happen when Joe Biden calls Powell and says, hey, what are you going to do? Well, the first thing he's got to do is take his foot off the gas pedal.
Yeah, but here's the real challenge, and I was talking about this with Charles Payne yesterday on Fox Business. The Fed's in a terrible spot. So, I mean, what do you choose here? Do you choose to combat inflation, which crushes, the stock market and really undermines the donors for the midterm elections that are coming up in November? I mean, those are right around the corner. Or, do you support the stock market and kill the bottom 80% of your voting base by not dealing with inflation? I mean, it's a no-win situation.
It's a no-win situation. That was my article that I published yesterday. The Fed's walking this tightrope where they're trying to contain financial stability or keep financial stability and tame inflation. And maybe they'll get lucky, right? Inflation could easily start falling come March, April, May, just due to the math behind it and some of the normalization of the economy. Omicron's going to, fade away as we get into the spring months. So there are some factors that could just push inflation down on its own. But
Tips may be telling you that already. I mean, if you take a look at a chart on Tips, it's been falling rather sharply here over the last couple of months, and that suggests that maybe inflation has already peaked, and this is a huge problem for the Fed. Now they're going to be aggressive about hiking rates and tightening monetary policy at the same time that inflation has already peaked. Now you're late to the party. Now you create bigger problems.
Right. So just real quick, if you go back and look at March and April of last year, those monthly inflation rates were like 0.6, 0.8, 0.9%, which if you annualize those, some of them are double digit, 10% growth rates.
Right.
So if you get anything less than that come this March, April, May, the year over year inflation rate will start declining. So I think that's benefiting the Fed. But the pressure, and this is why I mentioned what happened last night in the Senate, the pressure is increasing rapidly on the Fed to do something.
Right.
And they may, like you said, they could stop QE at next Wednesday's meeting. They could increase rates by 50, I doubt that they're going to raise rates at next Wednesday's meeting, but my guess is they're going to set the table up for a rate increase at the March meeting. Whether it's 25 or 50, we don't know what they're going to do.
Right.
But they're probably going to set the table up for 4 or 5 rate hikes this year. Yep. Enough Fed governors have been saying that's where they're leaning.
Right. And again, but the problem comes back to, again, this is a reduction of monetary policy, right? So they're taking out that liquidity support for the markets. Now you're hiking rates. Look, mortgage rates are already up a full basis point. Now you're going to increase the overnight lending rate by say even a point this year. That's going to drive long-term mortgage rates up probably another half point to a point before something actually breaks. Because again, we have to remember the economy is so heavily leveraged. I mean, we're running a massive deficit. You've got record margin debt. You've got record corporate debt, record consumer debt. Changes in rates are going to have an almost immediate impact on consumption. If you just take a look at recent spending. Real wages aren't keeping up with inflation. We've seen a big surge in credit card debt just over the last month of people just trying to make ends meet. So if interest rates go up at all, you're going to have a contraction in economic growth, which, by the way, will fix your inflation problem, but it gives you a much bigger problem for the markets and particularly for the midterm elections. If the economy's slowing sharply heading into midterms, your incumbent individuals will be out of a job in November. So we'll be right back after the break. We'll pick up with Michael Lebowitz. Flipping this over to take a look at the markets. What does, if the Fed does hike rates, what if they do, reduce their balance sheet? What areas of the markets may be safe to put money into? We'll talk about that next with Michael Lebowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Can we get to really big news today? Important news. Today is the 110th anniversary of Oreos.
Oh, man.
They are celebrating it with a new Oreo cookie flavor called chocolate confetti cake.
Chocolate confetti cake.
Yeah, so 110 years. That just makes your whole day better. Doesn't matter how bad things are, eat an Oreo.
The Real Investment Show podcast.
When's the last time you had an Oreo?
1911.
At realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. Register now at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, Michael Lebowitz joining me, talking a little bit about the Fed now becoming much more aggressive in theory about hiking rates. Again, pressure from the White House now to do something about inflation. And that pressure is going to potentially push the Fed to act more aggressively here. And we can kind of go back to 2018 and kind of replay the tape a bit when the Fed was hiking rates. And in September of 2018, Jerome Powell says, well, we're nowhere near the neutral rate. We're going to have to keep hiking rates more. And the market declines by 20% because obviously much more aggressive interest rate policy that's going to reduce lending activity in markets, those type of things. So markets start to reevaluate price, right, and valuation. And right now we have trailing valuations on the S&P are trading right around 39 times earnings. So we've got more companies than ever in history trading at 20 and 30 times price to sales, which is just astronomically overvalued. So if the Fed becomes more aggressive on rate hikes, you're going to have a repricing of risk in the markets. And again, replaying the tape back to 2018, the Fed says, hey, we're nowhere near the neutral rate. 2 months later and 20% lower, the Fed says, oh, guess what? We're actually right there at the neutral rate. But what were we thinking? And they stopped hiking rates, and the market started to recover at that point. But it didn't take much. And the difference is the Fed didn't have 7% inflation to deal with. The question this time, and as I was asking Mike earlier, is the Fed's in a much different situation. They have inflation. The question is now, is it transient inflation still, or is it now more persistent? People are believing it to be more persistent now. And as I discussed yesterday, there's a big difference between
inflation and disinflation. As Mike properly noted in the last segment, is that over the next couple of months, we're going to start to see inflation peak and come down just because of the year-over-year rate of change. That doesn't mean that doesn't mean what you're paying for a gallon of gasoline at the pump changed. If you pay $4 today and for gasoline and $4 a year from now for gasoline, the inflation rate is zero because it didn't go up in price. But you're still paying $4 a gallon in gasoline. And if your wages aren't keeping up with the rate of inflation, that's a problem.
I would add to that,
Go
Lance.
ahead.
The price can actually keep going up, and the rate of inflation can go down.
That is also true. But so here's the question, Mike. With all this kind of weighing on the markets, again, you've got an overvaluation. You've got now liquidity being withdrawn from the markets. Not just the Fed's liquidity, which has been the whole kind of bullish premise is, hey, if the Fed's doing QE, buy stocks, right? But you also have all the fiscal liquidity, the $5 trillion worth of fiscal liquidity that was put in. And to your point about the vote last night, outside of the vote on the voting rights bill, which was one thing, the bigger vote was the inability to repeal the filibuster. If they could have repealed the filibuster, they could have passed the Build Back Better plan with a 51 vote margin rather than having 60. So with the filibuster not being overturned, now they have no ability to pass really any of their spending plans between now and the midterms. And this is going to mean all that liquidity that is now evaporated from the markets isn't coming back. There is no help coming in terms of liquidity. This is going to be a much bigger problem for stocks potentially over the next few months. So now we need to start thinking about, where do we invest? Where's going to be the place to put money over the next few months as we head towards midterm elections?
Right. And I think the market is going through what I would call a pricing in process. So what do we have to look forward to? We talked about the Fed. Will they raise rates 4 or 5 times? Will they do QT? What will they do? You talked about what the government's not going to do, right? They're not going to do a lot of what they did last year. They're going to run a deficit that's going to look much more aligned with what we're running pre-pandemic. What are companies going to do? What are consumers going to do? So the market is starting to price in, and whether it's 90% of the way there or 10% of the way there, that's the hard part. But it's pricing in this new environment, a new environment that is not nearly as friendly to stocks. But what kind of stocks, right? Mm-hmm. It's not as friendly to growth stocks, but it's still pretty friendly to some value stocks that are cheap. So when you start thinking about what's going on, go back to the price that you're paying. Am I in the environment where I can buy something at a price to sales of 15 or 20 or a price to earnings of 70 or 80 or 100 or multiple hundreds? Or should I be playing it safe with not necessarily a conservative company, a conservative stock? And those are two different things. You mentioned on Charles Payne's Fox Business show yesterday, Lance, he asked you, I think it was Procter & Gamble.
Right.
He said something like, so is Procter & Gamble value? And you said something to the effect of, it's a conservative stock, but it's far from value.
Is it a value stock? No, it's not.
Right. Actually, it was a more definitive no.
Yeah,
right?
I mean, Procter & Gamble's a great company, but it's trading at 25 times forward earnings.
Right.
Right. And I mean, and this is the problem. I was talking about, price to sales, and this is a very important concept for people to understand. Back in 2000, when Sun Micro was trading at 10 times price to sales, Scott McNealy, and we've had this quote several times. Mike has used it, I've used it in blogs we've written. But Scott McNealy said, in order to sustain price to sales, I have to pay out 100% of everything I make. Right? I don't pay employees. I don't pay the IRS. I don't pay dividends. I don't pay anything. Right? I'm paying out 100% of everything I make in terms of revenue, which is both illegal and illogical. Why would you pay 10 times price to sales for a company? In order to sustain 2 times price to sales, a company has to basically grow sales at 20% every year just to maintain their current price at 2 times price to sales. Procter & Gamble's trading 5 times price to sales. They're going to have to grow their revenue almost 100% a year, every year, just to maintain the current price. You can't call that a value.
Right. But there is value. The problem is the market thinks of value as consumer staples, as healthcare, as financials, as energy. And it gets these things in its head that says, oh, it's Procter & Gamble, it's a consumer staple, it must be value.
Right. I mean, it's like Coke's trading at 7 times price to sales. McDonald's trading at multiples of sales. You know, and I think, and Mike, I think there's a bigger issue here. It's not just the market thinking about these things in terms of staples being a value. It's ETF buying. People are buying value ETFs, would just have all these traditional value stocks lumped into them. They're not really a value. But as we talked about recently in our report on passive indexing and the effect of that, when everybody's jumping in to buy a value ETF, it's pushing up the prices of all these underlying holdings of these ETFs.
Right. So if value is truly coming back into style, and I'm talking about over the next few years, not just for the next 3 weeks, what we're going to see, I believe, is first a shift to passive value. So that means ETFs that tend to hold more quote unquote value stocks, that hold the PGs, the McDonald's, the Cokes of the world, the Pepsis, regardless of what their PEs are. So they're not really looking at value. They're looking at what was or has been traditional value. Over time, though, I think as that doesn't pan out, you get a shift to real value. Companies that actually have a price to sales under 1, that have a PE below 12, that are actually true value. And there are some of those. And we're actually going to report on some of those on Friday's Simple Visor scan that we run every Friday. There are companies like that. You mentioned 2 on the Charles Payne show. But at first, I don't think that investors have to worry about how do I find the next value stock. I think they have to understand that the market, whether it's people's 401ks or big institutions or even hedge funds, are so focused on this passive investing craze that they're just going to go, we're going to sell the S&P and we're going to buy the Vanguard Value Fund. Or, we're going to shift a little bit more to value, a little bit away from growth. So the trade will be, well, what are the top 10 stocks in the value fund? Doesn't matter if they're value or not. And I guarantee you, 70% of them are not really value without even looking at what's in the Vanguard Value Fund. But over time, I think you'll get a better shift to more real value. And again, if this whole value rotation is real, right, we could in 3 or 4 months find the Fed saying, whoa, what are we doing? The market's down 20%. We got to start doing QE. And then all of a sudden, the Democrats and Republicans start singing Kumbaya and say, oh, we got to get fiscal going. This isn't good. The economy got down a 1% growth. What are we going to do? We've outlawed recessions already, right? We have to just put the turbo thrusters on, at which point we just shift right back to growth.
Right. Just as since you brought it up, the top 10 holdings of the Vanguard Value ETF are Berkshire Hathaway, United Health Group, J.P. Morgan Chase, Johnson & Johnson, Procter & Gamble, Pfizer, Bank of America, Broadcom, ExxonMobil, and Abbott Laboratories. And by the way, Berkshire Hathaway and Johnson & Johnson and United Health Group and J.P. Morgan, those are in the top 20 holdings of the S&P as well. So, again, there's, none of those stocks on that list are actually truly value. It's just, again, to your point, they're just lumped into the value kind of bucket that traditionally tends to be value. It doesn't mean these companies really are value stocks. And again, kind of understanding the difference. And when we come back from the break, you're working on this report for Friday on value stocks, but let's talk about a little bit about if somebody wants to actually screen for true value, how do you identify value from a value trap? We'll be back after the break. Talk with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. Realinvestmentadvice.com. Click on the insurance tab.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Michael Lebowitz joining me. So again, kind of the big, conundrum here is how to invest for this year coming up when there's so many headwinds coming in from less liquidity, the Fed tightening, hiking rates, reducing their balance sheet, slower economic growth, inflation, so many things, right? I mean, it's easy to get, super bearish and go, I'm just going to be in cash. I'm just going to get out and be in cash. And you know what? That could work out well this year. Could. Might not. Again, things change. And, this is the big problem with making predictions is that things can change. Right now, the Fed is teed up for next week to potentially talk about a much more aggressive rate hiking campaign, reducing their balance sheet. They could come out and say, you know what, we're kind of monitoring everything. We're not going to do anything right now. We're just going to, we're thinking about hiking rates. I mean, they could start to backpedal. I'm not saying they will. I'm just saying things change. And when things change, that's going to change the environment for the markets. And so, this is why we have to be nimble and pay attention to what's going on, particularly in a year like we're going to be in this year, where things will be reversing from earnings to economic growth to inflation, whole variety of things. So, and this is what we were talking about a second ago, and we think that value will be, kind of one of the places to be because it tends to hold up better during market declines. Now, it doesn't mean it makes money. It just means it doesn't go down as much as the market. So, but there's a difference between, as we were saying before the break, a lot of companies that are called value stocks are not really value stocks. Procter & Gamble, McDonald's, Coca-Cola. These companies aren't value. These are not value stocks anymore. They are very overvalued, but they happen to be in a category that is called value, right? And those are two different things. So the question is how can you find, what are some of the parameters if you're going to be wanting to look at value stocks? How do you find a value stock that is not a value trap? Now, what is that? A value trap is a company that looks cheap, but it's cheap for a reason. I could make the case that Peloton is now a value stock after collapsing from $160 to $20 a share. It's not. That's a value trap. it may be cheap in price, but it doesn't mean it's an underpriced company. And those are two very different things. Mike, your thoughts?
Yeah, a lot of it has to do with future growth. What are you paying? When you're buying stocks, you're buying a stream of income. Mm-hmm. So what you want to know is A, the valuation, how much am I buying? And B, what am I buying? Because yes, it may have, a company you're looking at may have very low PE, price to sales. But what if it's a company like Philip Morris or Altria that's actually shrinking? People are smoking less, right? So you have to factor in, well, what if growth declines by 2% a year? What if growth only increases by 2% a year? I know the price is low, but what am I getting for that money? And that's what you really have to think about. It's not just the price, but it's the growth and the prospects for the industry. And as we kind of get into a slower economic growth, more typical, right? Where we've been for the last 10 years, we can't keep assuming the economy is going to grow at 5%. And we have to start thinking about, well, if the economy goes back to growing at 2 to 3%, what does that mean for this sector or that sector? What kind of growth rates? Will people buy less cars? Will they buy more of something else? And it's a dynamic process where you're looking at the status today, but also going forward. And you can't get caught in value traps. And there's a lot of them out there. Like you said, Lance, there's a reason some companies are very cheap, and it's because they're not delivering.
That's right. So, and again, this is going to be the important thing to actually pay attention to. So again, look, there's tons of places where you can get a screener. So you can screen for stocks. Simplevisor.com, which is our platform. You can screen for stocks. You can set up screens that screen for value. But I mean, basically, you go anywhere. There's just Google screener on, and Google, and you're going to get about 1 million places that'll provide stock screens. And so you can start plugging in, different variables. Price to sales below 2. Price to earnings below 15, right? Those are the things that are traditionally considered, measures for a more value-based company. But the problem is you're going to come up with a lot of companies you've never heard of, and B, you need to also combine that. Again, just because something comes up on a screen, and I mentioned a couple yesterday on Fox Business, Nucor, as an example, Nucor Steel. Well, it's been doing well recently because of the whole supply chain shortage, kind of shutdown, reopening of the economy. Yes, it still fits a lot of the fundamental underpinnings, has good, strong earnings per share growth, has a low valuation, forward valuations are low, but it's had a big run. So again, you can't disregard where we are price-wise as well. So this is, we spend a lot of time on the show talking about the technical setup for the markets or for a stock. It's oversold, it's overbought. And what those technical overlays tell you is, is it a good opportunity to enter that position now? Because, again, stocks only move up so far before they're going to have a correction, which would give you a better entry price later. So don't discount the value of some basic technical analysis as well when overlay that with your fundamental underpinnings. So you can find a good value stock, just make sure you're also entering it at the right time as well.
And Lance, I would add to that also, we're in an environment where interest rates are rising. Mm-hmm. We're in an environment where a lot of companies have a lot of debt and have to roll over that debt. So be careful of quote unquote value companies that have a lot of debt on their books, because they may be rolling over that debt, what used to be 2% at 4% or 5%, and that will squash those future earnings. And what we thought was value may have been actually the right price or even too expensive.
Right.
So think about the environment. Think about the technicals. Think about, not just the next year, but the next 5 years. And again, think about the price. And does that price, contain the range of outcomes you expect?
Yeah, and this is going to be a challenge though. This will be a challenge for many investors going forward is trying to differentiate between investing and speculating. And again, we've been taught to speculate now for the last really 5 years in particular. but more so since the financial since the COVID shutdown in March of 2020, we really brought speculation into the markets because of all this liquidity. We gave $14 checks to kids with Robinhood apps to go buy stocks. And, that really distorted a lot of the things happening in the markets. And again, if you take a look at companies like Procter & Gamble, like Johnson & Johnson, these are good companies, but they're trading at price to sales that should never happen. But it is because of what we've done to the markets over the last couple of years. And this is going to be a much more challenging environment going forward to make money in, for a while, potentially.
Right. And earlier, just a couple seconds ago, I was talking about think about the range of outcomes. I think what makes this so hard is that range of outcomes is enormous over the next 6 months to year. Whereas we were a little bit more so on a glide path last year. We knew the Fed was going to keep doing what they were doing. The fiscal situation was a lot more predictable. There was no election to deal with to be concerned about. And we watched valuations rise. We watched speculative fever rise. We saw speculation go in and out of SPACs and IPOs, high-tech companies, disruptive technology. We've seen it since come out of many of those sectors. But as we look forward, what's the hardest thing is that the range of economic and fundamental outcomes is so much wider than it was. It's almost like we're back to March of 2020, where we have no idea what's going to happen. Not that we don't have any idea. I mean, the pandemic was a truly unique situation, but we're entering a period that is very unlike the last year and a half. And I think we've gotten very used to this speculative behavior. Now we got to become investors again. And we got to think about value. We got to think about, what are we buying? Does it make sense? Would you buy another type of investment? Would you buy your local bar? Would you buy your local dry cleaner at that kind of value, knowing that you're going to get revenue of X and Y over the next 10 years? And I think hopefully the mindset resorts back to a market where people are actually looking at financial statements and thinking about the economy versus what's been the hottest stock for the last 10 days. I got to buy it. Well, what's Kathy Wood buying? What's Jim Cramer talking about?
Well, but let me throw a little bit of let me play kind of the spoil here. But, again, let's go back to the whole problem with passive indexing and ETFs is that, we've seen such a shift there in terms of money flows going into these, into ETFs, which, own a basket of stocks. Again, we talked about Apple and Microsoft and those stocks recently. Apple's in 356 different ETFs on the large cap side. So every time those ETFs get bought, Apple keeps getting pushed up in price.
Not all those are large cap either.
Well, exactly. But the point I'm making here is it possible that we don't get a return to true value? We only get a return to approximate value because of people chasing ETFs. You got about 10 seconds, Mike.
You're right. Everyone's become a passive investor, and that's unfortunately the environment we're in, and that may not change. So we may, when we shift to value, maybe Procter & Gamble and J&J, not true value.
Yeah, we'll see. We'll keep you up to date, though. That's what we're going to do here on the show and on our website. We've got a lot of stuff going on there now, really more so than ever. Weekly market updates with Wealthion on the website now, as well as our daily market commentary, our newsletter, daily blog posts, Mike's articles. It's just a tremendous amount of information to help you manage your money better. Of course, really easy while you're there. Send us a question, comment, or email. Let us know what we can do to help you. RealInvestmentAdvice.com. Also check out SimpleVisor, our fully automated research platform. It's now up and running, SimpleVisor.com. It's all there for you as well. RealInvestmentAdvice.com. Be back here tomorrow for Financial Fitness Friday. Have a great day.